Welcome. We can start in just about 20 seconds here. Looks like.
They're making a slow check in here.
All right, hello everybody. Welcome. Let's see, make sure we got recording here first, actually. This computer. Record on this computer. And then we'll
Recording in progress.
Our live stream is down today for some reason, a little technical difficulty. But we'll be recording, and then we will upload it to the live stream. So I want to welcome everybody. Hello, and welcome to another Capital Gains Tax Solutions Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to unlock financial freedom, in the sense that you don't have to be stuck in an asset that doesn't allow you some diversification, liquidity, ability to buy deals that make sense when they make sense, or invest in different assets at lower prices. And today we're going to be talking about the deferred sales trust, is what we always talk about typically, and how it's a more resilient financial solution. And for those who don't know me, my name is Brett Swartz, and I'm founder of Capital Gains Tax Solutions. A little bit about my background: I was raised in California in an entrepreneurial real estate family in the Bay Area. I was inspired from a young age by my parents, who believed that, being your own, owner of a business can help unlock freedom, especially if you own real estate. And so we would buy and build houses. They taught me that real estate wasn't just about bricks and mortar. It was like a blueprint for achieving more of like the financial dream, or the American dream, which is part of a financial dream. And so, fulfilled by this passion, I went on to specialize in multifamily brokerage at Marcus & Millichap, focusing on 1031 exchanges, which we thought was like the tax deferral strategy for forever, right? It was going to be the end-all, be-all for real estate investors and for us as we were building our wealth. And life was on track for a while until my career was flourishing until about 2008, when everything kind of hit the fan and the financial crisis hit like a tidal wave, and I saw the direct impact not only for my clients, friends, and family, but also for my wife and I, who were just barely married, baby on the way, out of college, and really kind of having to grow up quickly, right? So we also found that a lot of our clients felt trapped by just the rigid 1031 exchange system, and essentially a lot of them either lost half, or some of them lost all of their wealth because they had too much debt, not enough liquidity, and had overpaid for properties and not enough diversification. And so my wife and I were also in a financial challenge. We were broke, we were in debt, and we were out of time. And so we moved into my brother in a small condo, and we had our first daughter there. And that taught us a lot about what was really important for us, but also was kind of like a wake-up call that changed the trajectory of where I'm at today. And so this experience ignited basically a quest for a better, more resilient financial solution for my clients and also for myself. And that's when I met a tax attorney and a CPA who introduced me to the power of the deferred sales trust. And I realized that it had the potential to revolutionize the way high net worth individuals approach capital gains tax, exiting businesses or real estate or primary homes or cryptocurrency. At that point, cryptocurrency really wasn't around, but the rest of them were. And so I founded Capital Gains Tax Solutions on that desire to provide some freedom and flexibility, and to connect people with this solution across the country, whether that be a business professional, whether that be a financial advisor, real estate professional, or to give you that edge to help your client unlock the freedom that a lot of my clients wish they would have known about prior to the crash. And so part of what we do here at Capital Gains Tax Solutions is not just offer a financial service. In this scenario, we actually work with others who provide that financial service. We work with those who provide real estate investment services or securities investment services. But what we do is we provide a lifeline that kind of unlocks the complexities of capital gains tax, 1031 exchange restrictions, and essentially unlock freedom for you or your clients so that you don't have to go through the pain of what my clients went through. And if you're a business professional who's struggling with, hey, how am I going to have an edge over my competition? Well, it's by providing value in a way that gives transformational freedom for your clients using the deferred sales trust. And so we offer a way to preserve the capital gains tax, multiply wealth, and grant clients freedoms that are invaluable to live the life they want to live, whether that be for their time, whether that be an entrepreneurial freedom, whether that be for their family or making an impact. And that's essentially what we're talking about today. And that's our mission. It goes beyond just making a living or exiting well. It's about leading and inspiring the building of wealth and freedom through capital gains and estate tax solutions. So our clients can make an impact with their capital to be invested in families and communities, and or you as a business professional can do the same, right? You can make a difference for those families that you serve so that they can unlock the capital, because let's face it, $84 trillion is coming like a freight train in the next 18 years and is passing from the baby boomers essentially to the next generation, and we are on the front lines to be a part of a solution that unlocks freedom. That being said, I also am joined by some amazing people. And by the way, if you want to learn more about this, you go to capitalgainstaxsolutions.com. But I also am joined, it's not just myself, I'm joined by some amazing business professionals that are strategic alliances that we work together to simplify the deferred sales trust for you so that you can just move forward and close on your transaction using the DST. I have Jake Miller. He is a certified financial planner. He served in the military. He's out of the great state of Utah, but he travels the world. He speaks multiple languages. Jake Miller, how are you doing today?
Doing very well, Brett. Thank you for the introduction, and happy once again to be with you to help people focus not only on their cash flow, but their tax flow and optimize their situation.
Absolutely. We also have Jake Carpenter. He's also a wealth advisor out of the state of Washington. He also has a unique skill set of not just securities, but also real estate. Jake Carpenter, how are you today, sir?
Wonderful. It's great to be here. Excited to have another conversation about the deferred sales trust.
Phenomenal. We have Rebecca Munson joining us today. Good to see you again, Rebecca. She is a Lake Tahoe truckee, realtor extraordinaire, expert in luxury high-end stuff. She is the expert in that area. Rebecca, how are we doing today?
Great, Brett. Excited to have another conversation about the deferred sales trust again.
Fantastic. And then we have the Micah Miller, who is the other half of Jake Miller, and she is fantastic about organizing and running the business with Jake. Mike, how are we doing today?
Doing well. I don't think I've ever shared this, but I am a couple of generations deep of real estate as well.
That's good to know. Okay, so the family in the background, that's fantastic. Well, great. Let's kick it off. Jake Miller, tell a little bit about my story, and I weaved in some of the challenges that clients face when it comes to exiting, right? But I want you to answer the question: what makes the deferred sales trust a resilient financial solution for someone who might be listening right now?
Very, very good question, Brett. And in fact, I have a presentation to a bunch of roofing company owners specifically about the deferred sales trust. And that's exactly what they want to hear. They want to know, hey, my exit strategy, I've been doing roofing for 20, 30, 40 years, however long. They've built up their company, they have their employees, they have their equipment, their assets, and their clientele, what have you. And they want to know, what do I do? If a big conglomerate wants to buy me out, the best scenario possible, and just give me a big chunk of money, how much of that would I otherwise lose? And how do I avoid losing that big chunk of money to the government? How do I stop the revenue share, or at least delay or defer it right now and what I'd otherwise pay in taxes? And we have a plan for that. That is the deferred sales trust. If they have an eligible transaction of $1 million or more, with $1 million or more of actual capital gains allocated amount of that transaction, then a deferred sales trust can step in and receive the proceeds of that sale, essentially defer that transaction for the year, and allow them to reinvest in another. So a lot of these roofers, Brett, they want to move on to something different. Some of them want to be real estate people. I mean, they've been in the construction industry all their life. They know and understand real estate. And in fact, oftentimes are able to get distressed or terrible deals. I say terrible as in the price is very, very low and economical, because they have the expertise to fix the roofs, and they have all the contacts with the other contractors, etc. They want to be more They want to transition from being operators and owners of businesses and entrepreneurs to investors. And to help them make that transition, we have these fantastic, wonderful tax-saving tools such as the Deferred Sales Trust.
Very well said. Same question to Jake Carpenter. Jake Carpenter, how do you see that the Deferred Sales Trust is a resilient financial solution for anyone who's selling a $1 million net proceed, $1 million gain asset in today's environment?
You know, the key to working with the Deferred Sales Trust for most of my clients, the ones that we've worked with, Brett, is flexibility. Being able to say, okay, I'm taking this roofing business, I'm taking this, whatever kind of business it is. It doesn't have to be real estate, which is the other thing I like about the Deferred Sales Trust, is this works with the sale of any highly appreciated asset. Not just a business that does not qualify for a 1031 exchange, but it can work with a business, it can work with cryptocurrency, it can work with individual stocks, it can work with real estate, and then you can exit that highly appreciated asset. You can then have the flexibility to do a variety of other things, whether it be active or passive. A lot of these folks that Jake Miller is talking about, they want to go on and continue to do some active things. So they would have a choice. Do they want the proceeds that were parked inside the trust? And think of the trust as like a 401k, right? As long as the proceeds stay in the trust, it stays tax deferred. But now they can decide, do they want to use those proceeds and passively invest them in real estate based syndications with Jake Miller that will just create passive income. Then they've got passive income to then go on and focus on something else. Or do they want to use those proceeds, partner up with the trust through an LLC, and then go out and actually use the trust proceeds to actively purchase and manage their own projects that they would then be responsible for running and managing and owning. So flexibility is the key.
Flexibility is the key. By the way, we asked the question to ChatGPT, who at this point, if you haven't discovered, is the answer to all things. No, not really, but it's pretty cool though. It's really cool. So I asked ChatGPT the same question: how's the Deferred Sales Trust considered a resilient financial solution? And by the way, I'm asking this question for a reason. And here it is. Most just think that the Deferred Sales Trust, or might think, if you're learning about it for the first time, it's just dealing with tax, right? It's just deferring tax, right? It's just helping me, not have to pay tax today and defer it, right? But it's important to understand that it's actually more of it's more than that. It is definitely that, but it's also a financial solution that helps you to build and create and as well as preserve more wealth, right? So number one is definitely tax deferral. If you're curious, 25 essentially is kind of the minimum to up to 50% of your gain is subject to capital gains tax and depreciation recapture, depending on what state you live in, and depending on what kind of asset you held and how much you depreciated. So if you're selling like a $10 million asset in California, for example, 40% is a good number. That 40%, if you had a zero basis, would equal $4 million in tax. Ouch, right? So you could have $10 million inside the Deferred Sales Trust or $6 million net of tax. And so the first thing is a resilient financial solution because it allows you for the deferral of taxes on the sale of the asset, enabling people to essentially manage their income more efficiently and even perhaps more conservatively because they have a 10 million as the total number versus 6, which means they have an extra, let's say, 4 million of margin that they can be investing that can be producing a return or income. Most of our clients are looking for a steady, reliable stream of cash flow. That's definitely number one. Also, a steady, reliable opportunistic fund, if you will, to go back into deals if and when they make sense. Now, funds can stay 100% liquid, which is also great because it goes into what Jake Carpenter just said, the flexibility of movement of funds, which is so key, right? Because in today's environment, you want something to be resilient, meaning it can move quickly, not be stuck. And so the ability to be liquid right now is so important. Number two reason that ChatGPT said was estate planning. It offers a deferred sales trust is a resilient financial solution because of estate planning. It offers flexibility in income and estate planning needs, such as the estate tax, which is a 40% death tax above and beyond a stepped-up basis. Without having to buy charitable, or have to buy life insurance, or have to give it all the way to charity, having a bunch of kids, we can eliminate that estate tax, and that helps to create a resilient financial solution for generations to come. I want to pass this next one to Jake Miller. Jake Miller, let's talk about saving a failed 1031 exchange, right? How would the DST be a resilient financial solution if someone's like, hey, I'm a multi-family investor, I buy and sell 1, 3, 5, 10, $50 million deals. I do 1031 exchanges all the time, but sometimes I run out of time. So how is the DST a fail safe for a failed 1031 exchange?
Exactly. It's just another one of those options that can actually step in. And with the deferred sales trust, if a 1031 doesn't happen the way that we all hope and wish that they would, which if somebody's done this several times, Brett, at 1031, they know that problems arise and that 1031s don't always end up in a non-taxable situation, as well as if they had their hopes on a property that just isn't going to happen, they need another solution. And you can't find it in like-kind property, you can't find within deadlines, there's all these things that could come up. So then at this point, think of the deferred sales trust as that 11th hour Hail Mary last bit option, so to speak. It's what can actually step in and be the recipient of the funds, of the basis, of everything that's being rolled over. And a qualified intermediary handles that transition. A qualified intermediary that understands and has experience with deferred sales trusts, who is a qualified intermediary for 1031 exchanges, facilitates the transition smoothly, Brett, when communication and all the information, relevant information, is in the hands of the qualified intermediary in time. And so it's not just, hey, Mr. Client, just, if a 1031's not working out, just know that a deferred sales trust is another option. That's a little bit more preparation than that. We actually have to set up with the qualified intermediary the deferred sales trust as a fail-safe, and then should the 1031 not go through, the deferred sales trust takes hold of it and actually happens.
Absolutely, well said. I'm going to move to Rebecca here, talking about high-end primary homes and how do I not have to even eliminate the need for the 1031 exchange, because luxury primary homes do not work for a 1031. But I want to just touch on that, Jake, and anyone who's listening. All what Jake said, plus it doesn't force your hands, right? It doesn't put you in the handcuffs to just have to comply by what the seller says as it pertains to negotiating any kind of credit for what you found during due diligence, and maybe having to overpay, having to feel like you have to overpay for a property. In fact, we just saved a failed 1031 exchange for a client. In fact, he was selling an asset in Texas, and he was doing a partial 1031, and he was also doing a partial deferred sales trust, and so he only could find enough property that made sense for him to replace basically about half of his exchange. The other half went into the deferred sales trust. So it allows you to buy deals that make sense for you based upon the intrinsic value of the real estate, and not have to force a square peg in a round hole, meaning equal or greater value and equal or greater debt. Now, important to understand that for basis is not transferable into the deferred sales trust. So you always want to make sure that you're replacing at least the debt from the asset that you sold with the new purchased property of the debt if you're selling investment real estate, especially as it pertains to debt over adjusted basis. And for a quick review on that as well, what is adjusted basis? Well, it's what you paid for the property plus improvements minus depreciation. Let's imagine you paid $1 million for a property. You added $500,000 of capital improvements, and then you'll take depreciation over, let's say, 10 years of $300,000. Let's just say hypothetically. In that scenario, you have about a $1.2 million adjusted basis. Now check with your CPA. You want to make sure you got all these numbers lined up very clear, so there's no ambiguity here. But essentially, you can defer all of the capital gains tax using a deferred sales trust, as long as you don't have debt over adjusted basis. We use what's called a Delaware statutory trust at times to replace debt over that adjusted basis. So these are just a few things that we help navigate with you and with your CPA to make sure everyone's on the exact same page so there's no surprises. That being said, I'm bringing Rebecca Munson. Rebecca, talk about how the deferred sales trust is considered, in your mind, a resilient financial solution for somebody who's selling a high-end primary home, let's just say in Lake Tahoe. Let's put it on the Kings Beach on the California side, right? And the tax is somewhere around 33% because it's their primary house and they've owned it for, let's just call it 20 years. And kids are gone and the house is now worth $7 million. It's on the lake, and they bought it for about $1 million, right? And they made a little bit of improvements into it, but they're looking at like a $6 million gain. Talk about how the deferred sales trust can be an amazing solution for that seller.
Well, it can be an amazing solution because 33% of that gain, so $2 million or so, right? They're going to have to pay capital gains tax on if they don't use this deferred sales trust. But it enables them to, sell that property if they need some of the money to purchase another one. But maybe, let's say they own a second home somewhere else and they're going to make that their primary. Then it allows them to take all of that and not have to reinvest it, not pay capital gains tax on it, and put it in the deferred sales trust and then start earning passive income through it. And then looking at maybe other investment tools that allows them to diversify. It allows them to maybe change their primary residence area, so many different things.
Absolutely. The way we think about it is a lot of people feel like real estate rich, right? Tons of appreciation, tons of value on paper, but maybe cash flow light, right? And they want to unlock the sleeping giant of equity so that it can start to go to work for them and produce cash flow. But they're living in the house and they go, I have no 1031 option, right? And they're going, but wait, this deferred sales trust, I could sell. And by the way, even if they have a 1031 option, do they really want to trade their $7 million property and they are, let's say 50, 60, or 70 years old at this point and start to be in the investment real estate game? Probably not, right? At least not all into one property, one asset, one location, which is typically what a 1031 forces you into, is a pigeonhole of not diversifying, not having liquidity, and having to replace typically all of the debt, right? So that's not great. Rather, you can move into the deferred sales trust, defer the tax, and we can diversify into some of the biggest companies in the world. We keep the money 100% liquid. You can view the funds online 24/7, and that cash flow can start coming out. So let's just do some rough numbers. You might be curious, like, well, what would the cash flow be on like a $7 million asset? Imagine it was free and clear, right? And all $7 million goes into the trust. Well, typically between 5 and 9%, depending on your risk tolerance. Let's just use 7 for this example. 7 million at 7% has a good ring to it. That's like about $490,000 of cash flow. So unless you're doing some exotic, cool, like Airbnb right on the lake, like boat tours, and like, I don't know how you're making, about $40,000 a month, right? And then you're living in the house. That would be a really amazing, extreme Airbnb. If you have something like that, let me know. I'll invest with you. But what we're saying is we're unlocking this capital and we're getting it to work for you and produce cash flow. And that's just generally speaking what a return might be. Now, these returns aren't guaranteed. What you're doing here is you're taking on a promissory note. So we would find a buyer. Rebecca would list the property, find a buyer, negotiate a great price, and the trust jumps in right in between you and the buyer and purchase your property for $7 million. And gives you a promissory note. Says it owes you this $7 million plus an interest rate in this scenario 7%, or about $40,000 a month. And then the trust immediately sells it to the buyer who's lined up, and the cash hits the trust, right? So the trust bought and sold for the same price, no gain. You received a promissory note, it's owed back to you. The buyer takes the property, he's on the beach on Tahoe, riding the boats, doing all the cool things, and you have this promissory note and the funds are invested, it's producing this cash flow. Now you might say, well, what if I want to buy that place in Colorado or Texas or Florida, or I want to move to the Incline Village side, right? Can I still do that and take some of that money because I need a place to live? The answer is yes. It's not tax deferrable. It will be taxable. We'll just say you want to buy $1 million cabin on the Nevada side. Can you do that? Of course. We would schedule a payment of that 7 immediately. and that payment would go to you. You pay tax on that, okay? The other $6 million would be the promissory note, right? So it'd be $7, but immediately $1 million paid out, and you could use that for a down payment, of course. Can you use the income produced from the trust to help you establish some more income? Because you might say, well, my income is not qualifying. Well, guess what? You get the trust going, and the income coming in. I've seen banks qualify somebody in a couple months of that recurring income. Rebecca, you want to add anything else to that for someone who might be curious about using this for their luxury big home in Tahoe or Truckee or any other place that they might be selling the house?
Yeah, I mean, it enables you to be flexible as far as the sales price goes too, and it gives you a little bit of room that you may not have to have that, crazy high dollar, because all of a sudden, you have a little bit more flexibility, and you might get multiple offers. It just, it creates a lot of flexibility, and yeah, being able to use that money to maybe purchase another property in Nevada or Colorado or wherever it is. Yeah, I mean, not having to, you only pay capital gains on that small amount. So
yeah, it's so great. And by the way, it's not just a little bit; it's $2 million in this scenario, right? If your basis was $1 million and you're selling for $7, now if you're married, depending if you're married or single, you do have what's called a 250 exclusion or 500, but essentially it's about a $2 million tax deferral. Now, you might be wondering, well, can I buy investment real estate with it? Like, let's say I wanted to move to Santa Cruz and I wanted to move from the beach of Tahoe to the beaches of, let's move to La Jolla, even a little bit warmer down there, right? San Diego. Could I do that? And could I do an Airbnb property, right? And could I, maybe use it for a couple weeks a year, but mostly Airbnb it out, or do a rental place down there? The answer is yes. The trust can partner with you to go buy into an investment property, all tax deferred. That is really cool, right? Just want to point that out for those who are in real estate. That's my favorite. That's my love. When the deals make sense, right? That's the key. Now you might invest those monies for $7 million, while these stocks or the markets maybe a little bit lower. Work with one of the financial advisors like Jake Carpenter, Jake Miller, to figure out that plan. But a couple of years from now, the values could drop, and all of a sudden we're finding good real estate that's on discount. Because guess what? Real estate typically drags for the valuations. It's like a big ship. It takes a little bit longer to turn when markets shift. Stock market tends to react faster because these are liquid investments, right? Just FYI, you probably know that, but just a reminder, it took 3 years from the 2008 crash for real estate values to hit the bottom. 2011 was the bottom, right? So the flexibility with timing is paramount for how the deferred sales trust helps you to create a resilient financial solution. Jake Carpenter, do you want to add anything that we just said here or subtract?
Yeah, I actually wanted to chime in because the conversation that I have with clients that are in a situation that would, maybe work with someone like Rebecca, they're sitting on a lot of equity in their home. And the question I ask those people, they're usually in their retirement years, and I ask them, how much income do you expect for your primary residence to provide for you in your retirement? And they kind of look at me kind of confused, like, our home doesn't really provide any income. But then I ask them, would you like it to be able to provide some income? And then we open up the conversation that, okay, let's sell this $7 million home, maybe, $1 million of basis or $2 million of basis and 121 exemption, right? All together. You've got this $5 million chunk of money that you can drop into the deferred sales trust to create additional income for you, and take that other $2 million, come up here to Washington or Idaho, probably buy yourself a mansion twice the size, or just a little home for $500,000-$600,000, working with Rebecca, and redeploy the rest of the capital for income. So that's a really powerful conversation to be able to have if you're sitting on a home that's highly appreciated and you're wondering, well, what are you going to do with all that extra, gain above your 121 exemption and your basis?
Very well said. Absolutely. And I want to pass it to Micah now. Mike is going to open up for questions and for anyone to ask, and she's going to kind of facilitate a little bit here. And or she might have some questions and thoughts that we're also learning every single day with the deferred sales trust that she might think is be a good question. I'll have Jake take the first one. Jake Miller take the first one. I'll take the second, and then we'll maybe move to Jake and Rebecca at that point. Mike, take it away.
Yeah, one quick comment though. I mean, really just the deferred sales trust helps anyone who is selling anything remove that hesitancy, because you might not know what your tax bill or tax liability is, but it really helps kind of facilitate you as the seller to have options. So I was going to say that. I did want you, Brett, to kind of explain a little bit about your role as the trustee and the safeguards that you have in place for like you as the trustee and note holders and kind of the roles and responsibilities there.
Yeah, but I will start with Jake answering that because it'll be good for people to hear it through Jake, and then I'll answer it, and then even Jake Carpenter, so people hear it from multiple perspectives. Jake, take it away.
Absolutely. So the job or position of the trustee, which this confuses some people, the trustee is the ultimate fiduciary. There might be financial advisors involved, which are fiduciaries for their limited access of what they manage or handle, etc., whatever. But the ultimate fiduciary for the trust is the trustee. There are a number of different protections allowed or permitted, even co-trustees, things of that nature, which financially make more sense when we're talking 50 million, 100 million, or beyond. Sometimes at a lower extent, just because people want to have additional controls in place so that a trustee doesn't have too much access or too much control, it can also be implemented. But to kind of answer your question, Micah, what the client wants to have accomplished is usually part of a discovery phone call. And then based on what they want to have accomplished, the trustee is there so that there's a deferral of the otherwise taxable transaction. Without the trustee and the trust, the clients would have constructive receipt and they would have to pay the taxes. There's a number of different ways that the trustee can coordinate and work with the clients moving forward. And that can all be discussed through a discovery phone call.
Very well said. Yeah, so all of that, yes, as well. Transparency, accountability, and the team, I think, is the biggest thing to understand. That you get 24/7 access to view funds online. For example, if you're investing with Jake, if they've trusted with Jake Miller and Micah, it's at Charles Schwab, right? Largest financial institution in the world. TD Ameritrade just came on, and the money's there. Jake Carpenter as well. If you're investing with him, he's investing, I believe, with them as well as like SCI and different groups. These are people that manage money for like the Mercedes-Benz pension fund and the MLB pension fund. So these are some of the most respected groups, and these are securities advisors. And as the trustee, I have access to look and review those funds, and so do you, right? Now, movement of funds takes dual approval. That's the other part of accountability. We have movement of funds that takes dual approval with you and me as a trustee. So nothing moves without your approval. We have systems in place and protocols in place for that. As well, a lot of our clients are doing deals, themselves, and they're opening up LLCs, and as the trustee, we're working with them and the tax attorney and their attorneys for the LLCs, and they are like it's kind of like checkbook control where they're running their own deals, and so that helps people to get comfortable there. It does take my approval for things. You may have heard that here what I'm saying, and that's important to understand. And if you don't own the trust, if you own the trust, you just basically sold it to yourself and issued yourself a promissory note, which becomes taxable, right? So that's why you are selling it to a third-party trust, of which I am the trustee over. So you might say, well, who technically owns the trust? Well, Capital Gains Tax Solution doesn't own it in the traditional way that you might think about it. It's actually a shareholder. Think of this like a business trust, but this actual trust cannot receive, or the shareholder cannot receive any money until it's paid you back what was put in plus a rate of return. So you are the creditor. You have all the rights and protections of a lender, and that enables you to have the legal rights to foreclose, take the asset back, and also have the approval or disapproval of investments. And so, yes, does that sound kind of complex? Yes. Is it? Yes, there's some complexities to this, but it's not unlike an IRA or a 401k or even a 1031. So a lot of similarities there where you are entrusting the capital with a third party in order to have a tax beneficial situation. That being said, I want to pass it to Jake Carpenter. Jake, you want to add anything else to that as far as the trustee is concerned and the financial advisor and how we work together?
Well, let me just say this: there are Brett Sports is not the only trustee that you can work with the deferred sales trust. But what I will say is that we work with Brett because of who Brett is as a person. We are a very close-knit team, all of us on this call. And so one of the reasons why I work with Brett is his integrity, his morals, his ethics, his philosophy, and how he cares about his clients. But he is a friendly trustee. So although he has to be totally disinterested, he can't be the seller's brother, cousin, family member, close friend. He does have a fiduciary responsibility to create some distance between you and the sales proceeds. Otherwise, as Jake Miller said, there would be constructive receipt. However, he does have to approve of the investment strategy. So he works with Jake Miller and myself and you as the seller to determine your risk profile, how much risk you want to take and what you want to invest in. He does have to approve of that, but he's really just there to make sure that, Mr. and Mrs. Smith that are in their late 70s and very conservative investors, if they all of a sudden get a wild hair because their grandson said that, cryptocurrency was the place to go and they want to put all of it in Bitcoin, Brett Swartz is going to step in and say, hold up here, let's talk. Let's just make sure that this is really what you want to do. So he's there to really protect you.
Absolutely. Okay, Mike, does that answer the question? How do we do? Or you want to add or highlight anything we said?
No, I like that. Another question that kind of came up, well, it didn't come up, but one that's come up before that I think would be good to highlight is just how the deferred sales trust can help separate partners. If you have a partner in an investment and you need to have diversity and options in that separation.
I'm going to throw this over to Rebecca, see how she does on this. So Rebecca, let's imagine there's a partnership and they own 300 units in Truckee, right? And they've owned it for 30 years. They're fully depreciated. It's zero basis. It's for $35 million, right? And let's make it 30 million. Let's make it simple, right? $30 million. They all have 10 million, 10 million, 10 million. They all want to exit. How's it going to help with this partnership? Or maybe they don't all want to exit because they're not sure if they want to pay the tax and they're all kind of figuring out what they're going to do. How's the deferred sales trust in your mind going to help them separate the partnership in a very efficient way?
Well, the deferred sales trust allows them to separate at the sale of the property. So one partner could elect to do a deferred sales trust, and the other two could elect not to, and they can pay the tax on their portion of their gains. They could all three elect to do a deferred sales trust, and each would have then their own independent deferred sales trust, and then could diversify and do different strategies. I haven't heard of them all staying together and doing a deferred sales trust as one. So you might be able to correct me if they can do that or not as a business. It's an individual thing.
Yeah, you nailed it. Great job, Rebecca. Yeah, typically not, right? Especially if it's three separate families, right? If it's a married couple, yeah, they can stay together in one trust. But let's say it's three separate couples, right? Different families. Each can have their own deferred sales trust. In fact, we just did an asset sale for a client in San Diego. It was a car wash, and it was 4 partners. Yeah, one elected to just pay his tax. He just wanted to just pay his tax. Great. There's $32 trillion of debt in America, and we need some people to try to pay that down, right? The other 3 said, hey, you know what, we'll do the deferred sales trust, and had their own trust created, and the trust is just business with them, right? Better way to put it was there was a trust created for each of them to just do business with them, right? And that the trust lent them the funds back at close of escrow. But the point was they were no longer commingled in the same asset or the same business venture, right? Now, could they also partner and continue to do business together? Of course, right? But they don't have to, right? And that's the key, because some of the partners, they might be 10 years older or 10 years younger. Some might be more active and entrepreneurial. Some might be more ready to retire, a little more conservative in their approach for investing. And that's the beauty of the flexibility and how this creates a more resilient financial solution, because the answer to all of this is really, what's the best, most resilient way for you to build your financial future? And what tool or strategy is going to help you get there? And how do we customize it to make it fit your goals, your risk tolerances? And that's the beauty of the DST You don't have to stay in the partnership, right? It can be a great way for sellers who maybe they're arguing about selling because of the tax, right? In fact, we've seen that happen before, where one partner says, "I am not selling because I don't want to pay the 40% in tax." And the other one's like, "I absolutely selling because I'm ready to retire." And and now 5 years ago or 10 years ago when they first got into it, no one was thinking about selling, but things had changed. Guess what? One partner may buy out the other partner. Let's say one person wants to stay in the business. In fact, we had a client, his partners bought him out. So it doesn't take all of these sellers selling all at the same time. In other words, one seller can be bought out and they can just do the deferred sales trust. And then at the end of the scenario, there was 3 partners. The other 2 just stayed in. They bought the partner out. He exited. The other 2 partners took 100% ownership. He, on his 33%, went to a deferred sales trust. I'll pause there. That's a whole lot. Micah, how does that answer the question? Are you feeling good about that one?
Yep, I love it. Love it. So I think we've kind of hit that a lot. I do like how you were expressing how it can allow some people to pause and kind of coast, and others to kind of accelerate and do what they want to do, right? So one other thing before we open it up for Q&A, or if you have other things you want to do, but I was thinking that we ought to touch a little bit about passing it on to kids and how that can work within the state.
Jake Miller and Brigham, I'm going to team up. Jake, I've got a $100 million estate. It's all inside of my taxable estate. It's in businesses and real estate. I've got 5 kids, Jake, and Jake Miller. Jake Miller, and I'm considering using deferred sales trust. How would this pass to my kids? Who would be the beneficiary? And why would I use this versus maybe some other strategies that are out there?
Absolutely. Let's talk about what would happen if you didn't do anything and passed away. Typically, real estate, there's a step up in basis, which is fantastic and nice. The business interests, depending on how things are organized, they could have something similar, if it's stock or things of that nature, happen to that as well. However, there is what's called the death tax, which we often talk about how the death tax is one of the IRS's biggest mousetraps, in the sense that a lot of times people don't realize that the exemption that they give us is a moving target that's subject to change every single year. And in fact, here at the end of 2025 or the beginning of 2026, it resets to what it was in 2017, which is half what the exemption is right now. So on this $100 million estate, where there would normally be a married filing joint, $24 million plus exemption, the last half of that, or the last piece or segment, which would be roughly 75 million or so, would be subject to a 40% estate tax. Now the exemption, the 24, goes down to 12 here at the end of 2025 or the beginning of 2026, and could at any given time through legislation go further down. In fact, it was only 20-something years ago, and it was only 600,000. And in fact, for people who are not American citizens but have assets in the States or business interests and things of that nature, the death tax has a much lower threshold. So the death tax, or the estate tax of 40%, is a huge, critical, perhaps the biggest expense of most people's life, even though it is incurred after their death. To answer the question, how does the DST help us there? Well, a lot of things need to be taken into consideration. You can go buy life insurance policies. You can do a lot of other types of estate planning. If your goal is to pass your stuff, the assets, on to the next generation without change. Now more than ever before, Brett, people are not wanting to pass their stuff on to their kids. Why? I mean, they want to pass on the value, but they don't want to pass on the stuff. There's emotion attached, and some kids worked in the business, some kids lived or helped build the real estate or whatever, right? And the parents, more than ever before, are realizing, their attorneys are telling them, you need to make conscious, deliberate decisions now so that your kids who love each other today don't hate each other tomorrow when they have to decide amongst themselves what mom and dad really wanted and how to give them their assets and everything else. And so a lot of parents, grandparents, the senior individuals that have accumulated all of these assets over 60, 80 years of their life are starting to sell them off, which would otherwise incur very large capital gains. Maybe not the estate tax right now today, but large capital gains and things of that nature. By utilizing the deferred sales trust, we're able to actually freeze the value that is in their estate today through the work of promissory notes and everything else, and allow outside of their estate within the deferred sales trust those assets to continue to grow in a way that can more effectively and efficiently the value be passed on to their heirs or be utilized by their heirs in the future. So this becomes, as Jay Carpenter often quotes me saying, the keystone strategy amongst a lot of other types of planning, whether it be estate planning, income planning, retirement planning, investment planning. This becomes a keystone strategy that provides in one fell swoop the biggest difference when it comes to control over the timing of when you pay taxes.
Absolutely perfect, right? Thank you, Jake, for that. That was flawless. I want to highlight a few things here, okay, so everyone gets this and give you like some practical stuff, right? So let's say you had $1 billion of real estate, right? The big B, congratulations, that's amazing, right? Now, and you're like, by the way, I actually would like to have my kids just continue to own all of that real estate. Like, and your goal is to have them keep the real estate. Now, let's make it $1 billion plus 12 million, right? Which is essentially said to be the married couple in 2026. So yes, you get that $12 million exemption. This is all inside your taxable estate, right? We're assuming this, right? And you just die, and they get the stepped up basis, and they get to own the assets now, and you're pretty happy. But guess what's happening here? There's a 40% death tax on that $1 billion, which if I do my math right, it's $400 million, right, Jake? I believe that'd be right, $400 million. And so, guess what's probably going to happen? It's probably going to be a fire sale, okay, of a lot of stuff. Which, if you said I wanted them to own this stuff, the real estate, now they did for about 6 months, and then they have to either refinance, right, or they have to sell stuff. So I think the question here is, I would say, versus what? Versus the DST, right? The DST plus, that is, we could sell before you die. And let's just, this is a little bit morbid, but let's just be real practical here. Let's say, I got about 5 years left. All right, I got $1 billion plus 12 million. We could sell that billion plus 12 million today into the DST plus, and let's say 5 years from now, or 5 days from now, or 5 months from now, you pass away. Guess what? That $400 million has been eliminated. Okay, it's gone. Okay, and now that money that's in other things, and by the way, it could go back into real estate. It could go back. It's securities. It can go into hard money lending. You can build a business. You could go buy your next door neighbor's property. Okay, the one that looks just like yours, but maybe it's an extra 100 units if you own multifamily. The point is, if you want to not have to pay the 40% death tax on $1 billion, you need to use the DST plus before you die, so that we move the billion outside of the taxable estate. So I want to make that very, very clear. So that's number one. That's actually really it. I want to pass it to Jake Carpenter to see what he thinks about that. Any questions on that? And what's that book by Sam Zell? Am I being too subtle? Right? You hear this book? This, I guess, like a best-selling book. And was I clear enough, Jake, or did I miss anything?
Yeah. So the issue that most families don't realize that they have is the fact that parents may know about the death tax, but a lot of times the kids don't. And it's really something that the kids are going to have to deal with, and they're going to have to deal with it within about 9 months after the death of both mom and dad. So you're exactly right. What happens is the IRS sends them the tax bill. They start freaking out. They start going, okay, how are we going to raise this much cash in a couple of months? Then they got to sell things at a deep discount just to pay the tax. No one's going to pay you what your asset's worth if they know you have to sell it within a few weeks or within a few months. So what this does is, at the close, when those proceeds fund into the deferred sales trust plus, those are removed from your taxable estate. That's federal estate tax and potentially state estate tax, depending on the amount and what kind of asset, what your situation is. So, again, it's not something that takes years, or you have to have 15 kids to create a gifting strategy. It's immediately at close. So it's very powerful.
Amazing, Jake Carpenter. Thank you so much. And by the way, you can find Jake by going to carpentercapital.llc. Jake, something like that. What is it again?
Yeah, carpentercapitalllc.com.
Okay, that's Jake. Okay, cool. And then Strategic Tax Solutions for Jake Miller and Micah, and then capitalgainstaxsolutions.com if you're curious. So we actually have a question that I got a direct question here. It says, in the example, in your example, is the initial transfer to the DST trust itself taxable? So the answer is no. Not if you put 100% of the equity at closing, and not if there was, as long as there wasn't any debt over adjusted basis. Then the answer is no. If you had debt over adjusted basis, the DST is not able to defer that amount. That would be taxed at ordinary income tax rates. But as long as you put 100% of the net proceeds, you're in a deferral state. Now, the DST Plus does have a unique difference between the DST 1.0, the DST 2.0. When you start receiving payments out, it will be partial capital gains tax and partial income tax. So it's like a blend, okay? Whereas the DST 1.0, as long as you're only taking interest payments, you're just paying ordinary income tax, 1099 INT. You're not dipping into principal. You're not paying capital gains taxes. And so, because someone might say, well, why not just use the DST 2.0 for everything, right? Well, it's also a little more rigid on how the payment not only comes out, but when it turns on, it doesn't stop. Okay, it's based upon your life expectancy, and so it's not for everybody, right? Just that's why we have a 1.0 and a 2.0, right? Now, sometimes we do a 1 and a 2, and typically a 1 for the first 10 million per married couple per year, because of what's called the IRS interest charge on installment sales. Up to 10 million is no interest charge on a married couple. 5 million per person per year, no interest charge. And then we use a DST 2.0, and so. But if you have the $1 billion in big assets, what's amazing, let's say you have one that's worth 100 million, we can sell that tomorrow. Boom, we just eliminated basically $40 million of estate tax, right? You have another one that's worth 200 million, we can sell that one the next day, and we eliminated, instead of 40, we eliminated $80 million of estate tax, right? And we just keep this going until essentially you say all of my billion is outside of my taxable estate. I've eliminated this $400 million, and I can make a bigger impact. Or will you finish the sentence? I don't know what that means for you, right? And you can also give it all away to charity, which is fantastic too. We're here to provide options for you. You decide. But if you want to be entrepreneurial, you want to be flexible, you want to have adjustability, and you want to eliminate that estate tax, the DST Plus is amazing. Jake Miller, let's kind of wrap this thing up, and or Micah, let's take this thing home, because we only have about 7 minutes before everyone else is be on these callers. Something else you want to add, subtract, highlight? Go Jake Miller, then Micah, then we'll wrap it up.
Absolutely. I think that mostly people should just recognize that we have a team of professionals to help them out with their very specific circumstance. This is one of those strategies that you really honestly cannot do it by yourself. You have to, for the deferral piece at least, have a trustee and have the trust that is injected in between you and the transaction, so that you don't take constructive receipt. In addition to that, everybody's circumstance is a little bit different. So that we can optimize your scenario, not only do we have our amazing team, but we need you and your advisors, your tax accountant, or whoever is closest to you that knows and understands the tax ramifications of what you've done in the past. We need their eyes on this transaction as well, so that we can educate them. 1, 2, they can give you the head nod that, hey, this works and this is correct. Or 3, they can give you the advice about, based on what else you have going on that maybe you haven't mentioned to us, what else we need to hear and know about, so that we can optimize your overall results of utilizing the deferred sales trust.
Amazing. We have one last question, then I'll pass it to Micah to share how everyone can be found. And it's this, and this can continue on into perpetuity with payments to the beneficiaries. So the answer is yes. And so let's do the DST 1.0. What happens if you die with the DST 1.0? Well, if you have a living trust, you would have a promissory note that's inside of the living trust, and your kids can step into your shoes and start receiving the cash flow from the trust. So that's one option. And let's say you had multiple kids, one kid might cash out of 50% of it, just pay tax right there. They will pay tax as they receive it. Okay, they do not get a stepped up basis, but they get to step into your shoes and continue on. Now the DST 2.0 over here, the actual kids are the beneficiaries, right? And that's the cool part in the respects here. It doesn't have to be just your kids, by the way. You just can't be a married spouse, but it might be grandkids, it might be niece or nephews, okay? But essentially, they inherit it as the beneficiaries, estate tax free, and they can decide to continue on with the trust and continue to build a wealth through the trust with us, trustee, financial advisors, commercial real estate. That being said, Micah, if people want to get in touch, why don't you give everyone's, if you have it all? If not, just give your guys' and I'll give the rest. But go ahead, Micah. Where can people find us?
Yeah, so you can find us at strategictaxsolutions.com, or you can call 800-778-1848. Happy to talk to you. Happy to help answer any questions.
Excellent. That's Mike and Jake. And if you want to get in touch with me, you can go to capitalgainstaxsolutions.com. Now, do mention that you watched all of this here, and so that we could bring in the appropriate professionals to help execute on this. Rebecca Munson, if people want to find you, where can they find you?
They can find me at RebeccaMunson.com or 530-448-9740.
Amazing. Jake Carpenter, one last time, where people find you if they want to find you?
CarpenterCapitalLLC.com, or you can call 509-396-5292.
Awesome, Jake. Hey, if you want to check out the book, Building Capital Gains Tax Exit Plan, go buy it. Hit #1 bestseller. It's on Amazon. The book's on fire. It's really doing great. We have DJ Meller, who's in the book, Kevin Harrington from Shark Tank. And it's all about helping you get even more clarity on everything we're talking about, create a clear, compelling vision. And remember, momentum is the force behind that's going to propel your vision forward, right? And it's even more powerful than all of the some of your leadership, your strategy, and your resources combined is what we believe. And so take what you just heard today, take the next step of action, which is either booking a time with us, one-on-one consultation, getting the new book, get here next week, share this with somebody, take action. We also have experttaxsecrets.com, our coaching program for business professionals if you're wanting to take the next level and leveling up how to offer the deferred sales trust and other capital gains tax deferral strategies to your clients. Take action at experttaxsecrets.com. That being said, we'll see you all next week. Have a great weekend, everybody. Bye.